focus on climate change, acting as a wake-up call for decision makers to prioritize a more sustainable approach to investment. While growing concerns about climate change have already had a spread awareness about being socially responsible and a focus on ESG investing, the COVID-19 pandemic accentuated that belief and encouraged institutional investors to put ESG as an important condition for investing and impelled corporations to make such practices, ESG practices that is, an integral part of how any business is done. While ESG has been relevant before COVID-19, the pandemic has also brought to light how businesses and societies are dependent on each other, and therefore has emphasized the need for corporates to have a comprehensive environmental and sustainable policy that acts as a guiding light for sustainable growth. At NSE, we've always encouraged discussions on relevant and emerging issues that motivate corporates to enhance their business practices and enable policy dialogues among regulators. The overarching theme of the day's webinar is to address this prevalent theme. Does ESG investing generate alpha over the long term? What are the best practices in ESG investing? In order to have a very high-profile panel of renowned sustainability experts who will provide a 360-degree view of this, the significance of ESG investing. On behalf of NSE, I once again welcome you all to the webinar and hope you will find it useful and take some insights from the day's deliberations. I now pass on the baton to Sivnath. Over to you, Sivnath.
Thank you, Tirthankar. I want to thank National Stock Exchange and Buzz on Earth for this opportunity to talk about ESG with such an esteemed panel that we have here. So today's topic of discussion is ESG and alpha, right? So we want to talk about performance. We want to focus on how does ESG potentially has a link with performance and what are potential drivers of it, right? So that's the focus. So, we have been having these discussions around ESG for some time, but today's focus is alpha, right? So what I have is, I will start with some, a first set of questions is, just to set context with both the panelists as well as the participants. Before I want to get into some of the nitty-gritties of how ESG may or may not have a link with alpha. So my first question is to Mr. Mukesh Agarwal. Mr. Mukesh, you have NSE in the recent years have launched several ESG indexes. You have the Nifty 100 ESG. You have the Nifty 100 Enhanced ESG. You also have the recently launched the ESG Sector Leaders Index. Can you talk about what is the investment thesis or what's the thought process behind these different indexes?
Thanks, Shiva. Good afternoon, everyone. So as you mentioned, Shiva, that we have launched 3 indices. Over the last 2-3 years, we have launched 3 indices. So what we have done, we have taken our base indexes Nifty 100, which is the comprises of top 100 companies listed on NSE. And why we have taken 100 is because when we started constructing the index, we also need to look at what are the companies on which the data points are available. One is the ESG data plus ESG scoring, because reporting and all this data availability has been an issue. So based on that, so we decided to launch our indices initially focusing on Nifty 100. So we have taken Nifty 100 as the base index on which we have created 3 different indices. Now, people might ask me, what are the 3 different indices and how have we differentiated the 3? So I think it's a very, I would say, it's a sequential approach which we have taken. So first I will come to how do we go about constructing the Nifty 100 ESG index. So what we did, so just to share with all of everyone, so we are using the scores and the ratings or risk scores provided by Sustainalytics, which is a global leader in the rating and data availability on ESG for different companies. And recently they've been acquired by Morningstar. So what we have done is we look at, first of all, when we look at the base of 100 companies, we exclude all the companies which are present in 4 controversial sectors. These are alcohol, tobacco, gambling, and controversial weapons. So out of this top 100 companies, there are 3 such companies which get excluded. So I think these 3 companies are ITC, UBL, United USL United Spirits Limited and UBL. So we exclude these 3 companies. So we are left with 93 companies. And then what we do is, because if you look at the scaling of sustained analytics, which is on 0 to 100, 100 is the riskiest and 0 is the least risky. So what we do is we look at all companies which have a score of more than 40. Why we have chosen 40? Because 40 is more than 40 is considered to be severe risk. So we have looked at all the companies which have a score of more than 40, and then we have excluded those companies. And those companies are basically, there are 8 companies. So 8 plus 3, 11 companies get excluded. And there is 1 company out of Nifty 100 on which there is no ESG score available, not provided by Sustainalytics. So 3 plus 8 plus 1 company on which the score is not available. So this 12 companies get excluded. We are left with 88 companies. So taking these 88 companies, we have constructed the index, which we call it Nifty 100 ESG Index. So this is the Nifty 100 ESG Index, which comprises of 88 companies, removing 3 companies which are into controversial business, removing 8 companies which have a high risk or most severe risk scores, and 1 on which the scoring is not available. So this is 88 companies on which we have created Nifty 100 ESG scores. So now, sorry. No, I got it wrong. So we exclude 3 companies which are into controversial business, and then we exclude 8 companies which have a controversy score of 4 and 5. So just let me start again. Sorry for this confusion. So we exclude 3 companies which are into controversy business. Then Sustainalytics also gives the controversy score, which is 1 to 5. So all companies which are scored 4 and 5, which are severe controversy and high controversy, they are excluded. These are 8 companies, plus 1 company on which a score is not available, 3 plus 8 plus 1, 12 companies. So we are left with 88 companies, which is called Nifty 100 ESG score, Nifty 100 ESG index. Now, after that, what we do is, from there, we exclude companies whose risk score is more than 40. So we exclude those. There are 7 such companies. So we exclude those companies, and then we are left with 88 minus 7 is 81 companies. This index of 81 companies is called Nifty 100 Enhanced ESG Index. So that is what we have done for Enhanced Index. So why is it called Enhanced? Because we are looking at some ESG risk scores also. From there, this is a Nifty 100 ESG Enhanced Index. After that, what we have done is, this is the second index. Then we created one index on which we have an ETF, which is the ESG Sector Leader Index. What we did, all companies where the risk scores are more than the global risk scores of the same industry. What Sustainalytics does is they also give industry-wise average risk scores. So out of this remaining 81 companies, all the companies which have average risk scores more than the global risk scores of that particular industry, we remove those companies also. So 10 such companies get removed from there. And then what we do is, for each sector, we try to capture only companies which account for 75% of the market cap. So we'll go from top to bottom, largest to smallest. We will draw a line wherein we take enough number of companies which account for 75% of the market cap of those companies. And accordingly, then we create that index. So finally, we are left with 53 companies which we create, because we are calling it Sector Leader Index. We create leaders in each of the sectors which account for 75%. And we are left with 53 companies. We call it Nifty 100 ESG Sector Leader Index. So this is how we have created 3 indices. So I think now we would ask, why only 300? Why only 3 indices? Why only Nifty 100? As I mentioned earlier, this is again based on the data availability. As we move forward, more data is available, we will create more such indices.
Understood. I think it's germane that we started the discussion on benchmark, because we will come back to it. Because, if you have to talk about alpha, you need to talk about benchmarks, right? So that's I think good way to start the discussion. Now, let me turn over to Mr. Srinivas Jain. So Srinivas, a few years back, SBI took a strategic decision to reorient SBI Magnum, which is one of the largest and successful funds, to an ESG fund. So can you talk about, what's your investment rationale? What's your thought process behind changing the objective of your fund?
Yeah, hi, good afternoon. And thank you, Shiv. Thanks for inviting me to this webinar. Always a pleasure to talk on a topic that we both as a fund house is very committed, and I'm very passionate on it. Coming to your question on what actually made us think through ESG as a strategy. I mean, to be fair, at SBI Funds, we've been ESG has been kind of an integral to our investment process. It's also an explicit understanding that our investors actually want ESG, right? Even though they're not explicitly telling you that ESG is important, right? So the coverage has now been over a decade old. We've been using ESG as a natural process. We've evolved from coverage to a product in 2018 when we converted that to an ESG fund. Before that, we actually tested this as a portfolio management services product under a concept called growth with values. The concept worked very well. We've been building this capability over close to a decade by our investment thesis and principles around how we look at this whole ESG as a concept. We've also been very encouraged by our joint venture partners, Amundi, who own 37% stake, and they are world leaders when it comes to ESG investing. And their portfolio runs in $400-500 billion worth of ESG portfolio. Over the years, we've been thinking about how do you do that, right? The first step was to be part of this whole responsible investing framework, UNPRI, stewardship code of conduct. We started vertically integrating ESG as a part of our process before we made it a product, right? Another way to look at what we've been doing with ESG before we launched the product was show our commitment on various global initiatives, right? We were, as I said, we were the first to sign the UNPRI signatory. Incidentally, we are, UN Climate Action 100 Plus Asia Advocacy Group. We're part of that. The Climate Action 100 Plus itself has about 600 plus, investors globally with about $60 trillion worth of assets, right? I represent not just our fund house in India, and we've recently co-chaired that whole Asia Council part of it. Another thing that we've been doing is working with various multilateral forums like India-UK Sustainable Forum, like the CIA Climate Change Council. So why I'm trying to say all this to you is that before we thought about it as a product, we believed that as a concept. We've invested in that concept. It took us more than a decade. And then, of course, in 2018, we made that into a product. Today, it's a very popular product. It's the largest ESG strategy in India, almost close to 50% market share among all ESG products put together, and obviously growing. So I'll probably come back a little later and talk a little bit about how we do that. But I wanted to give you a context of how we built what we built and, the logic behind it. Yeah.
Understood. So just on, funds, if I turn over to Ashwin. So Ashwin, can you talk about your investment process behind, Access Equity Fund? I went through some of the prospectuses and so on. So can you give some, throw some light on, how do you incorporate ESG alongside traditional cash flow analysis, right? So yours is an integration status strategy, so to speak, right? So can you talk about, how do you, incorporate ESG alongside your traditional cash flow analysis?
Yeah, thanks for that, Shiv. So basically, I think the most important parameter for us, as you rightly said, was always been about doing a long-term analysis of companies' cash flows and trying to get ourselves convinced about the sustainability of these cash flows and the growth potential of these businesses. In that context, it's very interesting how we've had quite a big change in the way we are approaching ESG over the last, I would say, 3 to 5 years. We've gone from a scenario where we felt that governance was always something that was very critical part of our entire cash flow and company assessment. And we always felt that, since we were capturing governance, ENS were not really directly relevant to the financial matrix. And this is, I'm talking about maybe 3-5 years ago. And from there, I think it's very interesting because we've gone through and evolved as investors through our conversations with companies, etc. And today we are at a situation where we are maybe 2 or 3 years back, we realized that environmental and social as well issues are going to make a pretty dramatic difference to cash flows. They present risk, which may be difficult to enumerate, but a very concrete risk to the cash flows and maybe good opportunity in some cases as well. So what we've done is we have now started capturing ESG about 2 years ago. We've integrated that into our process, and we've now started capturing that as a part of the cash flows that we generate, as well as we've started doing ESG assessment as an integrated part of our research process itself. And therefore, as a result, what is happening now is that we believe that we have a much more holistic understanding of any business that we look at. If we are looking at a company for whatever sector we talk about, that company, not only do we have a good financial understanding, but we also have a broader understanding of the context of that company with the society, with the regulators, with its employees, with its customers, etc., and the entire stakeholder model. And this is something, again, very similar to what Srinivas and SBI have seen. Even we were really helped by our offshore JV partner, Schroders, in terms of their understanding that they were able to provide us as well. So we believe that this gives us a very, very holistic perspective of looking at a company, and it allows us to take this into account while taking long-term investment decisions. Why is this so important in our context? Just as a final point, is because our style also is typically long-term. We are long-term investors, so we would like across portfolios to take positions which we are convinced from a 3-5 year perspective. And having these holistic view becomes critical if you are going to be able to take a view on companies on a 3-5 year perspective.
Thank you. I think the general theme is that I think Srinivas mentioned process before product, and you mentioned it's a holistic analysis, right? It's not simply adding a score to the product, right? So simply for screening and so on, because it goes much more integrated compared to that, right? So we'll get back to some of these themes through the discussion. But if I can turn to Jal. So Jal, you have I read some of the reports from Edelweiss, some of them written by you on the topic of ESG. And I just want to focus on one particular report on global ESG trends that you had provided some commentary and analysis around. So Global Sustainability Investment Alliance released its Global Sustainability Investment Review, GSIR 2020, and it kind of provides a breakup of different kinds of investment strategy. Now, I know that, so I think both Ashwin's fund as well as, SBI's fund, it follows an integration approach. But clearly, in the past, there were exclusions, and those kind of strategies were more popular. So can you talk about how investment approaches to ESG has changed over time, and what could it mean for the performance of these strategies?
Yeah. So thank you, Shiva, the CFA Institute and the NSE for having me on this forum. So globally, there are several investment strategies, but it's broadly put into 7 buckets. I mean, there are 7 sustainable investment strategies, generally speaking. Of that, 2 of the strategies are overwhelmingly large. And till recently, the largest strategy was a simple negative or exclusionary strategy. So what it simply means is that if you're a tobacco company, then you could be either excluded, you cannot be, you're not investable altogether, or then you can give a lower weight. So if you let's say are a carbon emitting company, you may not have a 0 weight, but you will have a decreased weight of 50 or 75%. So till about 2 years back, that was the dominant strategy, and that's where pretty much most people start with. Now, what we have seen globally in the last 2-3 years, that the second largest strategy, which is ESG Integration.
Did we lose Jal?
I can't hear him.
Okay.
Yeah, looks like.
Okay.
ESG integration strategy. What that strategy really means is that what companies actually do, what is the bottom-up performance matters more. And just because you are unfortunately in a polluting industry, of course you'd be penalized. But then what do you do beyond that? Can you be net carbon zero, and how? So those strategies are taking center stage, and therefore incrementally it is very important that firstly, the Indian.
Lost it.
Yeah. Okay. So maybe let's come back to him. So hopefully he can join.
It is no wonder that in the last year we have seen domestically alone about $1.5 billion or 8 to 9 new funds being launched because it's now basically the bottom-up integration strategy which is making a significant difference.
Understood. Yeah, so Jal, I think we lost you for just a second.
I'm sorry. Okay.
Yeah. So I think you were talking about polluting companies as an example, and you said that so it doesn't matter if you're a polluting company, it matters what you are doing to kind of address some of the situation and so on. So was there another example you picked, or was there something that you said?
So there wasn't an example, but to tell you more about it, essentially the polluting companies would generally attract a lower valuation, and potentially the whole concept of is sustainability. So if you're a polluting company, generally, especially a polluting industry, and being disadvantaged to that extent, arguably you wouldn't have a significant life of cash flows, and therefore your valuations would suffer. Now, rather than being so you're still going to be in that industry, but rather than being completely excluded, that you're actually what is it actually you're doing to address some of those issues and announce that you're going to be net carbon zero? That actually result in a huge valuation re-rating, because that extends the sustainability of your cash flows, really. So to identify those sort of changes would give you a potentially huge alpha.
Understood. Got you. That's great. So, that kind of sets the background on what each one of you have been focusing on. But I would we want to talk about alpha and what potentially has a link to alpha, right? So let me start by asking about ESG ratings, right? So maybe I'll start with Srinivas and go to Ashwin. So there are studies that have shown that the correlation between ESG ratings by different providers, or potentially even by investors themselves, are very low, right? So investors don't typically agree on what is an ESG outperformer or an ESG laggard, and that correlation is between the third-party providers is about 60%. Just for comparison, a study also mentioned that credit ratings have a near perfect correlation, right? So if a company is rated AAA, it's very very rare that Moody's will disagree and say it's a triple B or a double B. But whereas in ESG, that correlation is only around 60%, right? So the implication is that ESG analysis is subjective. Most investors don't have a similar view of companies' ESG performance. If they don't have a similar view on companies' ESG performance, then it is possibly difficult to attribute a portfolio performance to an ESG factor, right? So Srinivas, what do you think about this subjectivity and how it impacts, how you perform the analysis, how you communicate with investors on, what's the story on ESG, and potentially, how do you ask, field any questions as to, why is this company there and not in this benchmark and things like that?
Yeah, it's interesting you asked that, because it's a very important question. Like everything else, this is an evolving segment, right? So, and you gave a very interesting question about credit rating and credit as how there is a near close correlation between different rating agencies. Why can't that happen for ESG, right? Basically, if you look at ESG is not precisely an exact science like a credit rating agency, right? So, in a credit rating process, there is a debt equity structure, there's an indebtedness, there is an interest coverage of the company. There's a mathematical calculations that are involved. In ESG analysis, one is assessing the both qualitative and quantitative parameters, and quantitative actually is becoming even more a bigger segment, right? An ESG score or a rating is basically a function of both quality, quantity, and these kind of changes. Like Mukesh, my friend, can tell you their methodology based on the inputs that they've got has already undergone a change 3 times, right? Because it's evolving. It's something that that keeps moving. So we've seen that there've been a divergence of opinion among investors, rating agencies, and this is going to happen. Recently, SEBI actually set up the group think tank. We've been talking. We made a recommendation on standardization and at least some processes around there, at least from benchmarking point of view, right? So I think while the methodologies are different, rating approaches may vary between us and let's say in case of risk, it's a risk exposure that may vary. But I think over time, these things will start kind of harmonizing and will get harmonized, right? So I think for an investment manager, it's critical for transparency, right? So basically, we need to disclose to the investor what is the investment process that we are following for our ESG dedicated funds. And that's very critical. The amount of disclosure that you're going to do is going to make a big difference. So basically, for us, it's more about the whole process. We put up every single data point that's there, whether it's inclusion or exclusion. In fact, interestingly, our joint venture partner that I talked about, they've come with a very interesting methodology. What Jal was kind of talking about, even more evolved. They call it as ESG improvers, right? And so now a global kind of a stair where you're trying to generate alpha by dynamically managing the ESG, prospects of it, right? So, we are not just doing exclusion-based, but picking ESG winners with various methodologies. So this is evolving. Over time, this will get better. The only way to solve this shift at this point of time is to have better disclosures on how you do it. Hopefully better benchmarks and better way to tell your investors what your beliefs are. But I think in coming years, you will have some 6 or 7 various sub-segments that you can easily benchmark and talk about. Until then, I think it's high quality disclosure by asset managers is what you can communicate to your customers.
Got you. So Ashwin, may I take have your quick take on this issue, like the subjectivity, this thing, and the implication that how can you So I think Srinivas talked about transparency, but internally, how do you manage the tension, right? So I think he mentioned that so even the benchmark, if it uses Sustainalytics, and you guys use a different process, right? So how do you manage the performance for even things like bonuses and all those things?
No, firstly, I think we have to be clear what the consumer of these ratings are. And, even if you look at credit rating agencies, they can all agree with each other, but at the same time, we've also seen AAA's defaulting, right? So it's not an exact science there either. If they all agree and they're all wrong, it's still not really useful for the market. But even if you look at ESG, who is this rating for? Who is the consumer of this rating? It's a reasonably complex field. I don't think it's meant for a very retail audience who will just use a simple blind use of that number or that rating and just sort of deploy it. If it's being used by informed participants and who understand the constraints with which these ratings are being produced, that's fine. I think, we don't use them. We have a different approach. But if other informed participants are using it with full knowledge of their shortcomings, they are serving their purpose, even if they're not agreeing with each other. They need not agree with each other for a simple reason that they may have different weights for the 3 different pillars, which is E, S, and G. So, as far as we are concerned, we've always been relatively more benchmark agnostic in terms of the way we deploy money. So, we've never really worried much about, just like we've never really much worried about credit ratings, we've never really much worried about ESG ratings for our ESG portfolios. We have a process, we want to invest based on our views. And to answer your question on performance, definitely, I think that is a little tricky, but at the end of the day, the proof of the pudding is not whether we are outperforming some ESG benchmark, but as a whole, is ESG field outperforming a non-ESG based approach? And I think if we start to see that happen, and probably it will take a cycle for this to clearly get established in India. We've just to very, very early days. I think not fair for me to overinterpret last 12, 18 months data, but if we see that happening over the next 3-5 years, ESG as a use of ESG is clearly delivering something over non-ESG benchmark. I think that's the most important thing. Then within ESG is not too fast about how at the back end people are doing it. It's important disclosure, but again, I think you need to be an informed investor for you to make sense of what's on offer here. I mean, just seeing a number and trying to react to that number has no meaning for anyone.
Got you. Interesting. So Mukesh, like just on this topic before we move on to the next one, I think Srinivas mentioned it, so I'm going to ask you, right? So you're using Sustainalytics, and Sustainalytics have changed their methodology, like couple of times in the last few years. So how does it impact, like your way of analyzing this thing when the underlying data undergoes some degree of changes, and potentially that ESG on its own is, like, on the whole, has a degree of subjectivity that we just talked about. So how do you manage that tension within the benchmarking process? Like, how does it impact that?
No, I think, Shiva, is a very relevant question you asked. I think first point I would like to make is any index we create, all our indices are rule-based. So our detailed approach and methodology for any index is put up on our website, and we need to follow that rule. So in our case, we looked at various rating providers or data providers on the ESG sites, and we decided to go ahead with Sustainalytics because we felt they are the appropriate ones. So we chose them. And once we choose them, then in our approach and methodology, we have to define what we will do and how will we go about it. Like as I told you initially, on the first index itself, Nifty 100 ESG index, we remove all the companies with a score of 4 and 5 on controversy score. So we do that. When we go to the enhanced ESG index, we said we remove all the companies with a risk score of greater than 40. Now, in between, as Srini correctly said, in between they had changed their methodology. So we also had to change our methodology and approach, how we use their ESG scoring, how we use their ESG data. But I don't think that was a big challenge for us. We need to understand it. And plus, also, if you look at it, our indices, whenever we make any changes to our indices, we also have a practice of taking market feedback, because today, whatever 9-10 funds you have in the market, active, you have 8 active funds or 9 active funds plus 1 ETF, and all of them are benchmarked against our indices. So we have a practice of taking market feedback. This is a change which has been done by Sustainalytics, and this is what we plan to do. And I think based on the market feedback, we went ahead and accepted the change approach and methodology given by Sustainalytics, and we did it. So that was not much of a challenge. Only thing is, whatever changes we do, we need to make sure that we put those changes in the public domain, and it is clearly defined in our methodology document, and it is acceptable to the users, because ultimately, whichever fund house uses our indices, they should be accepting our change in methodology. And since it was very logical and everyone accepted it, and we went ahead and changed it. So that is how we do it. But changes have been there. I think, as Srini said and others have said, this is an evolving concept. As we today also in India, we have only data are available on not many companies. Now SEBI has come out with the guidelines of making it compulsory for top 1,000 companies, compulsory from FY 22-23. As data availability increases, more companies will start reporting, then probably the methodology can again go through a fine-tuning and refining. So this fine-tuning and refining will continue to be there. This is an evolving subject, and we also as an index provider have to keep refining and fine-tuning our index approaches and methodology. That's what we need to do.
Understood. I think that provides a good segue into our next topic, which is, what is the impact of regulations on market evolution and potentially the market efficiency, right? So, I mean, we know that, for an efficient market, you have good quality comparable data. And recently, not very recently, but last year, so SEBI came out with this update, and it is called BRSR, Business Responsibility Sustainability Reporting, which is a huge update to the business responsibility reporting. It was it mandates a lot of granular information for 1,000 companies, like Mukesh, you just said. So I want to ask Jal, what is the potential impact of these widely available and comparable data on ESG investments, market efficiency, and potentially, will it democratize and potentially take away manager skill in that process?
So I think Mukesh clearly said, the biggest challenge today is availability of quality data. Now, to that extent, I think BRSR is a leap ahead over BRR in at least partially or significantly addressing that, not just partially addressing that. So firstly, if you try and understand, you see BRR was way back in 2012 and was eventually mandated to the top 1,000 companies, which BRSR will also mandates the top 1,000 companies to start with. But the big difference is that while BRR was more qualitative, BRSR is both qualitative as well as significantly quantitative. So, and also BRSR is provides significantly greater amount of granularity. So there are versus 59 questions in BRR, there are 140 questions in BRSR. And in fact, 300 plus quantitative indicators. The important thing beyond this is going to be that it will provide a tool where one can make, the corporates themselves now have a integrated reporting standard where they know what to report, and therefore we on the other side as fund managers or advisors then can make sense of this data. We've at least got the raw material to actually look at this data and analyze this data. Now, beyond this, what it also does, as onerous as it sounds, at the same time, what SEBI has done is that, of course, some of the leading companies are already incorporating global best practices such as GRI. So they are not, what they're looking to do is similar practices such as GRI are incorporated in BRSR. So they're not asking them to reinvent the wheel. But at the same time, what this will force companies to do, what BRSR also forces companies to do, is rather than the companies, and separate ESG division looking at these parameters separately, it requires actually the companies to look at it holistically and all the important businesses of the companies to get together and consideration all stakeholders. So it enhances the company's mindset itself in enhancing their longevity, their sustainability. So it's good on several fronts. Now, the shortfall is that this is mandatory only from next year. And also we will not have a time series, from year one. It will be a few years after which there'll be a time series. To answer the second part of your question, so the first part is that, the welcome relief will be, there'll be data to analyze. Okay. The second part of your question, just because you got the raw material doesn't mean that it's become an efficient market and that there's going to be no differentiation. Just because you have the earnings, balance sheet, cash flow of the companies doesn't mean that all the analysis is done. At the end of the day, whether it's advisors, fund managers have to do that analysis. So in fact, that is just the first step, and that will actually give advisors and investors the opportunity to analyze that data to start with.
So just to get a fund manager perspective, Ashwin, if I can start with you. So what is the implication for getting all this new set of indicators, the quantitative indicators, the qualitative indicators to your investment process? So essentially you're doing let's say if you're combining the fundamental process with all these new indicators. So does it make it better, but potentially your take, right? So would it make it tougher to kind of stand out from the rest of the people who have the same comparable access and so on? So Jal said that it's not just going to make it efficient, but what do you think?
I think no question, more data is better. I don't think anybody will grudge more transparency or having more data. What we have to, however, work for is to make sure that it is data which is usable, comparable, easily processable. One of the challenges we have is that definitions are not standardized. What is reported by one company and another company, can they really be compared, or are they sort of really the same things or not, is something that is not easily decipherable. We also have to look at second order, third order effects, which actually may not even be very easily capturable in certain sectors, even with best efforts from the companies. So there are certain things that data can achieve, and definitely more data is welcome. But beyond that, what is needed is more conversations and discussions around how to capture these things through the value chain. And I feel personally, and also looking at what our experience has been as a company, that just having the data in this kind of a case, because it is a non-financial data by itself, from a purely investing perspective, may not be enough. It's also going to be about interpretation. It's also going to be about forward looking. How is this data not just about a point in time, but about how it is evolving, about what is the strategy of the company, and how are they changing whatever they are doing today, and how will they look like 6-12 months down the road. So what are the materiality of certain data points? Not just enough to have a certain data point, but is it material to that company's business model or not? So I think it goes back to the very basic tenet of active investing, which is you have a bunch of data, but then you apply your qualitative assessment and your judgment on top of that data, overlay that on top of the data to come up with a complete assessment. Like we said, create a holistic understanding of the company. And that's really the best case scenario. So you have a lot of data and you have the ability to take the informed assessment using that data. I think those two coming together is what will really be needed. But to answer your original question, I think more data is absolutely needed, absolutely welcome. There is no question about it.
I'm probably moving on to the next one, which is benchmarking. I think we touched upon benchmarks right at the beginning. We talked about all these ESG indexes. So I'll probably ask Srini this question, right, around benchmarks. So now ESG funds have they have different investment approaches, right? So I think we spoke about it at the beginning, even earlier. Some of them have exposure to foreign holdings. Now some of them hold varying amount of stocks outside the stated benchmark. So outside of Nifty 100, they could hold some stocks and so on. Now, with all, and there is subjectivity when it comes to data itself, right? So benchmark might use Sustainalytics, doesn't mean that you are just going to follow the same approach or the same data provider or same thing when it comes to identifying outperformers or like that. If you have all these things, how appropriate is using a particular benchmark when it comes to even calculating alpha, right? At some point, would you think that the market will start needing more benchmarks, custom benchmarks, potentially blended benchmarks to, if you have foreign stocks and so on? Do you think there is as the market evolves, are we going to see more need for better benchmarking?
Yeah, thank you, Shiv. And in fact, it's again a very interesting question, right? Just look at the irony of this question. Few years back, when we wanted to do an ESG fund, in the domestic market, we were like struggling to have a benchmark, and we had to kind of develop something from scratch till Mukesh and his team came and gave us something interesting to work with, right? So from that idea today to you saying that is not good enough because there's so many other things that's happening itself is a fantastic thing that could happen, right? In a very, very short span. But I hear you there. I think for the index that, it has to be a base source on which the ESG scores, rating are used to construct the index. Like Mukesh gave a very analogy around how how NSE does it, right? So I think that is fundamentally we got to get it right. I mean, some of the variance can happen, but you get the fundamentals right. After that, you can use multi-service provider, you can do custom benchmark, you can do anything else, right? So you can create those cues, ratings, scoring methodology, all of these things can vary. But I think there has to be a fundamental belief that this is what gets in when an ESG scoring or ESG inclusion methodologies or exclusion methodologies put into place, right? So I think, thanks to Mukesh can say that almost all funds managed under his, index. So he should be very happy that there is nobody else trying to compete at this time. But I'm sure it's going to come. It's just a matter of time before you will start. Even Mukesh himself has 3, right? But there's going to be more of these, which will be better representative of changing portfolio constructs that are going to happen in the ESG form. I'm sure there'll be more blended indices that will come up. We've been working very hard to get our fixed income ESG integration for a while now. We've still not got that right. 3 years, 4 years project. It's a complicated thing to do. But we are hopeful that this year we will get at least the fixed income ESG right. So there are more complicated things that are happening there. But from, hopefully, I think over time, there'll be more benchmarks created, which will have better scoring or rating, or rating provider who will come, which will be aligning to individual goals. Until then, we'll have to go with what's kind of available. And to that extent, I think the SEBI's discussion around having some kind of a standardized approach to things will matter. And there was a huge debate around how this should be, but I think it's good to have initial standards. And over time, we will get a better hang of how this can be done. I think one of the problem with this discussion is that, and I give this example of how even Sustainalytics changed their
verifies on your returns. So now looking at the Nifty 100 as the base index, and if you compare the performance of other 3 indices, the 3 variants which we have created, if you look at the time horizons of 3 years, over 3 years, over 3 years, over 5 years, over 7 years, all the 3 indices have given higher annualized return than the base index of Nifty 100. So if you look at only the numbers of 5 years, if you look at the 5 years annualized returns, so one index is given 18.9%. What I'm talking about total return, because when you have index, we look at the price returns. On top of that, you add yield so that you get total returns. So I'm talking about total returns because that is what an investor typically gets. So if you look at total return over 5 years, one index is given 18.9, another index is given 19.1, third index is given 17.6, against which the base index Nifty 100 is given 16.5. This is the annualized return over the 5 years. Similarly, if you look at a 3-year period, one index is given annual return of 21.5, second index is given 21.9, third index is given 19.1, and the base index is given 18.4. So I've just shared the data, 3 years, 5 year annualized returns for the 3 variants of ESG we have created. All 3 have given higher returns than the base index of Nifty 100. Similarly, I would also like to share some data on global side MSCI. MSCI, they have all country world index. And on top of that, that is the base index on which they have created an ESG index, MSCI, ESG, ACWI, all MSCI, ESG, all country world index. So if you look at the performance of that index also, over a period of 5 years, that index has given returns of 13.9% per annum as compared to the base index, which is given 13.8. So the data points which I have shared clearly show that the ESG indices have given higher returns or generated alpha over the base index. Now, this is too early because it's a data of 5 years, 7 years, 3 years. We really need to look at the performance over a longer period of time. And it's a wait and watch. We have to see whether over a longer period, 15 years, 20 years, whether they will give higher returns or not.
Okay. Okay. So just a question on benchmarking, Mukesh. So I asked Srinivas about how appropriate is the benchmark, but from your perspective, do you see any demand for additional ESG indexes that reflects the fund manager's investment process accurately, right? So I think potentially, clearly, if a fund manager adopts sector relative ESG strategy, then potentially you have an index for that, right? But the way I see it is everything is benchmarked to potentially one index, right? The Nifty 100 ESG TRI. Are you having conversations, or do you see any demand for or is it too premature to talk about customization or more accurately reflecting the investment process?
See, so if you look at it, let's go back. I will go one back to the normal. Forget about the ESG. Today, let's talk about the ETF or passive investing industry per se. There also passive industry, we have around 4.13 lakh crores of 4.13 trillion rupees is the assets under management. So out of which, if you look at it, top 10 indices account for 90% plus of the assets. Within that, if you look at Nifty 50, which is the broad market capital, most popular index or benchmark index of the country, Nifty 50 accounts for 52 to 53% of the assets are tracking Nifty 50. Now, coming to here also, I think some of the base indices will remain there. Demand will keep coming in. If you look at it in normal indices also, we started with Nifty 50, Nifty 100, but off late, you are seeing more strategy, more themes. You are seeing CPSE index, you are seeing Alpha 50, you are seeing low volatility. So those demands will continue to be there. I think we will create more of those indices because people would like to differentiate themselves. And fund managers, fund managers will always like to see how they can launch a fund which has got a different investment strategy vis-a-vis others. So those demands will be there, but the issue is availability of data will be an issue. I think today, if you look at it, we have launched Nifty 100, which is only a large cap. I think first step will be to launch an ESG index on mid cap, then small cap. Probably then you will get into some sectorals. Now, globally, if you look at, you have indices on electrical vehicles, carbon, green, gender diversity, then women-dominated boards, women-dominated company. I think all those kind of variants will come. India, first of all, I think for each of these themes, you don't have too many listed companies. That is one constraint you have. Second constraint will be ESG data availability and also history. I think Jules correctly said that BRSR will come, but that will be from FY 22-23. But will you have the data for the past or not? So those are the challenges, but I think this is just evolving. And as we move forward, we will have many more variants and theme. We are all ready. Other thing which I wanted to say, I think somewhere we have been talking about better indices and all. I think all indices are good. More varieties will come. So we should not be saying that.
Appropriate indexes. Yeah.
So more appropriate indices, more themes, more different kinds of indices, different strategies. Those will evolve. I think as data availability keeps increasing, more indices will be launched.
Understood. So I have one question from the participants, which I want to ask Ashwin, and then we are kind of coming up on time. So, unfortunately, we have to stop after that. So Ashwin, an audience question is, companies do invest in improving their ESG profile, they take ESG initiatives and so on, and there is a short-term cash flow impact of undertaking some of those initiatives. Now, how do fund managers actually take into account when they do this fundamental analysis of that cost impact and what's the potential performance impact of that?
No, good question, and I think that goes essentially to the root of what ESG should be, because ultimately, if the company is being run with a long-term objective and they want to maximize the long-term value to all stakeholders, then the decision that they will take will maximize those things, and rather than trying to manage the company with a short-term, quarter-to-quarter mindset. In which case, you typically, when you take such capital investment decisions, you trade off versus the near-term cost versus the long-term benefits. So ultimately, as long as the near-term costs are more than compensated by the long-term benefits, and the benefits can be in two forms. It could be in the form of improving the cash flow, but it can also has an equally important second or alternate objective, which is to bring down the uncertainty or risk to the business. And we've seen so many businesses in India, abroad, where everything is hunky-dory, and then one fine day a massive controversy hits you or a massive backlash hits you because of certain practices, and a lot of the business plans go for a toss. So if you can spend something to take care of some of these concerns, and you're doing this not because for any other reason, but because you want to make the company more enhance its appeal to all stakeholders. And ultimately, that is in the interest of the company itself in the long run.
All right. So I think we are coming up at the hour. So this has been a most interesting, illuminating discussion. I think what we covered today is not just we started with the general investment process and what you guys are trying to do, but we also got into the drivers of performance, right? So potentially how does ESG ratings impact performance? How does the choice of benchmarks that could have an impact? What is the impact of policy perspectives on availability of data and market efficiency and skills and so on? And we also looked at some of the more fundamental aspects of ESG, right? So I think the cash flow perspective and how do you integrate the short term versus long term. So I want to thank the panelists, Mukesh, Srinivas, Jal, Ashwin, for your time, for your perspective today. I want to thank National Stock Exchange and Buzz on Earth for organizing this session. I want to thank the audience, some of whom have been listening in this platform and also through the YouTube platform. So I want to thank the audience for patiently listening to us. So there are more sessions being planned on this particular topic by National Stock Exchange. I hope that you're able to dial into future events as well.
Thank you.
Thanks.
Thank you.
Thank you. Bye-bye.
Bye.
Thank you.
Recording stopped.